Gas prices are expected to reach record highs this weekend across the GTA. Supply chain constraints are the biggest drivers behind the spike.
And political tensions in Europe have pushed crude oil to $90 a barrel on Wednesday for the first time since 2014. And late last year, Premier Doug Ford said his government still planned on sticking to a campaign promise of reducing the cost of gas by 10 cents. But so far, Ford hasn't taken any steps to make that happen, and the provincial election is just 5 months away. So these record prices have been predicted to come for a long time. Here to explain why is gas price watchdog Dan McTeague. Dan, thank you so much for joining us so much over the last little while. We appreciate it. Let's get into the why before we get into how high these prices can go. Why?
Well, there are three big major factors. You mentioned one, the tensions in Russia versus the Ukraine. That's obviously has a lot of traders concerned about the threat, the risk. The other one, of course, is oil itself has been on a bit of a rise, mostly to do with the fact that we are seeing what amounts to really a global shortage. The United States is a good example, produces normally pre-pandemic 13 million barrels a day. Now down to about 11.6 million barrels. It's still playing catch up. The rest of the world is in a very similar situation. But here in Canada, uniquely, the weakness in the Canadian dollar caused by a lack of interest and investment in the oil and gas sector, given all those years of protests and pipeline blockages, they're having their effect. And it's adding another 10 cents a litre. And of course, we can't forget the elephant in the room, carbon taxes, 10 cents a litre. These are things that didn't exist 3 or 4 years ago. And they're very much a part of why we're paying the price that we're paying here in the GTA, Toronto. And those happen to be now record prices, as you've indicated earlier, heading even higher as we head through the weekend.
I also want to bring in Jan Stuart, global energy economist of Cornerstone Macro. Jan, thanks for joining us as well tonight. This is something, these prices that we're seeing and we're going to expect to see getting worse, this didn't happen overnight, Jan.
While incoming, it's part of the recovery out of the downturn from COVID. During COVID's peak here in the in North America, in Europe, in Asia, during that peak in the first quarter and the second quarter of 2020, we had a decline in oil demand that was utterly unprecedented. We've been recovering from that. OPEC has done its bit in holding back supply, and what we now have are inventories that are exceptionally low. There is a persistent supply deficit, and demand is rising and will continue to rise for a while yet. So oil prices have predictably reacted to these fundamentals. We are at $90+ Brent, close to $90 WTI. For those very fundamental reasons. And that, yeah, like you said, that took a little while, but it shouldn't be that surprising.
Mm-hmm. And on that note, Dan, how much worse can it get? I mean, by the end of the year, are we going to be seeing, $2 a litre at the pump?
Well, Jan has touched on it. We're still playing catch up, but if we wind up in a situation where Russia and Ukraine actually are involved in a much greater conflict, a war, for instance, and that involves not just Europe that is desperate for natural gas and to a lesser extent other products, then of course we could see oil prices lift well beyond $120, maybe even $130. There really would be no limit in terms of where you would go. For Canada and for Canadians, with a weak Canadian dollar at the same time, not able to sell more oil or more natural gas to come to the rescue, as it were, of countries that need our energy, being the third largest provable reserves in the world, it would have a cataclysmic effect, and we would be well above $2 a litre in a very short period of time. The very fact that we're at 154 by Sunday, I think, is very telling.
Jan, to you now, why are supply chain constraints, why are they such a big driver of the spike in oil prices?
You know what, the supply chain constraints that really drive this are 100% political, right? I mean, OPEC plus, if you want to include Russia, Oman, and those kind of countries, are holding back supplies. That has been the story for the last 18 months. On the other side, you have that other bucket of suppliers, the industry. And like Dan was saying earlier, industry is no longer your favorite investment proposition, right? The industry of producing oil and gas has been shortchanged. And to be fair, the industry of oil and gas, especially the part that is American and taxes and back-end, those guys were interested in growing. Like they fancied themselves to be like the next, I don't know, Silicon Valley heroes. And all you had to do is burn money and grow. Well, that industry was not, in the end, your favorite investment vehicle anymore. That industry had to clean up. They now, only now, have become proper investable companies. Except, of course, now you're facing your ESG headwinds and you still can't invest in these companies properly. And so these companies aren't exactly drilling lights out like they would have done 3 or 4 years ago if you had given them $70 or $80 WTI. So the investable part of the market-driven part of the industry is on its back foot. OPEC and its political or the sovereign producers are squeezing the market. Where else is your supply going to come from? Maybe Iran eventually, possibly. We think so, yes. But that ain't going to be enough because demand, and that is the part that is most underestimated, demand is very, very strong here in Europe and especially in developed market economies. We are facing a trend incline in demand, and everybody that's selling EVs doesn't want to believe that. That's a really big problem.
Dan, you and I spoke about this recently, the campaign promise from Premier Ford to reduce the cost of gas by 10 cents a litre, which that promise was for March of this year, from top of my mind. Is that, the more and more we talk about rising gas prices, question one, is that still likely? Question two, do you think the federal government will intervene at any point?
Yeah, look, Christine, I don't think the federal government has any interest in intervening. I think their mandate, their mission, as well as those of most of the parties in the House of Commons, is to drive prices up so that people stop using fossil fuels. The problem, however, as Jan pointed out, demand is very much there, whether in Canada or around the world. I think it's even exceeding the International Energy's expectations. Remember, back in May, they said, "Oh, stop producing oil, stop making exploring to replace the oil that we're using today," only to go 3 weeks later on bended knee to the OPEC and say, "Please produce more." Of course, in Canada, we have a solution for some of the shortfallings in the United States. We produce heavy oil. Many of the United States refineries, still the largest consumer of oil products in the world, use Canadian oil. And of course, the fact that we saw on the first day of the Biden administration's taking office was a cancellation of a 80% built Keystone pipeline, I think, comes as a sad disappointment a year later. Perhaps it was a little rushed and short-sighted. But be it as it may, I think for the provincial government to drop gas taxes 5 or 10 cents a litre, we might see in this rise that is quickly eaten up, and there'd be no political benefit, certainly for anybody who drops it. As for the federal government itself, it's on course to raising carbon taxes on the 1st of April, 2.5 cents a litre. And of course, we have to switch from winter to summer gasoline, which is another 5 cents a litre come April 15th, and a carbon tax number 2, the Clean Fuel Standard, on December the 1st, another 4 or 5 cents a litre.
Okay. That's all the time we have. Dan, Jan, we appreciate both of your time tonight. And, let's wish everyone the best. There's not many places to go and people want to get out, but gas prices are high. Thanks so much, gentlemen.
Thanks.
All the best.